Hi everyone, my name is Edwin Lim. In this video, we will go through accounting for inventory. Inventory is such a huge topic, so we will cover it over 2 weeks. In this topic, we will first look at the cost of inventory. We should know what can and what shouldn't be included as part of the cost of inventory. We will also record inventory and perform closing entries using 2 inventory methods, the Perpetual method and the periodic count method. Please go through the learning objectives. Before going through today's topic, let's discuss revision question or case study 6. So what is this case about? A company called Roadhound wrote off $17.7 million following the collapse of Dick Smith, which is its biggest customer. The customer Dick Smith experienced cash flows issues and stocked up obsolete items, which fundamentally drove the failure. When Dick Smith failed to pay the outstanding amount, Roadhound declared it as bad debt. In the previous topic, we learned that we can use 2 methods to account for bad debts, the direct write-off method and the allowance method. In the first question, you are required to explain why the direct write-off method is not preferred by accounting standards. Why is it not consistent with the conceptual framework principles? And what are the limitations? So there are several limitations that you can highlight. First of all, direct write-off method only records a bad debt when we confirm that a particular customer will not pay. This is inconsistent with accounting principles because it ignores the probability of debtors discharging their outstanding accounts. And this probability will vary with the length of time. If customers' payments are overdue, we should record the bad and doubtful debt expense on balance day under the adjusting entry. However, there is a delay in recognizing this bad debt because it may only be recorded in the next accounting period when customer is confirmed to have defaulted the payment. So it overstates accounts receivable in the current period because it is not recorded at the net realizable value. Next, this method also fails the periodic, matching and accrual assumptions under the conceptual framework. As mentioned, we do not do any balance day adjustment for receivables under the direct write-off method, and we delay bad debt expense recognition. We are not using revenue and expense in the same period to calculate periodic profit, so profit is distorted and not so useful for decision making. And finally, a sudden write-off of the bad debt in the future period can cause a sudden drop in profitability, which causes profit volatility. Profit volatility indicates risk, and investors do not like volatile profit because they find volatile profits confusing. They cannot tell whether the company is profit or loss making in the long run. So because of those reasons, the allowance method is preferred by the accounting standards. In the second part of the question, you are required to analyze how would the write-off of Dick Smith's debt affect Roadhound's net receivables under the allowance method. And note that this question is not asking about accounts receivable per se, but it is asking about net accounts receivable. So we know that Roadhound wrote off $17.7 million of bad debt. However, this has no impact on net receivables under the allowance method. Why is that so? Recall that on balance sheet, we present 3 lines: gross accounts receivable minus allowance for doubtful debt in order to derive net receivables. When the bad debts are written off under the allowance method, we debit allowance for doubtful debt to reduce the allowance, which is a contra asset account, and we credit to reduce accounts receivable. So mathematically, gross accounts receivable decreased by $17.7 million, and allowance for doubtful debt also decreased by $17.7 million. So mathematically, negative 17.7 minus negative 17.7, so it becomes negative 17.7 plus 17.7, so which is zero impact on net receivables. Alright, let's go through today's topic. IAS 2 or ESB 102 is the standard that guides us how to account for inventory. There are three types of inventories. First, finished goods that are held for sale in the ordinary course of business. Second, work in progress, which are goods in the production for such sale. Third, raw materials, which are used in the production process or used for providing services. For example, if your business makes and sells motor vehicles, showroom motor vehicles will be the finished goods. Work in process inventory will include any motor vehicles on the assembly line, and all components like metal, glass, engine, and plastic will be raw materials. So, what is the main difference between inventory and PPE, property, plant, and equipment? The major difference is that we hold inventory for sale to make a profit. So we frequently sell inventory, purchase and sell inventory. However, for property, plant, and equipment, we hold it for a certain period of time. Because we use property, plant, and equipment for a certain period of time, most of the time beyond 12 months, to generate economic benefits. And we do not frequently trade property, plant, and equipment to make a profit. To make a profit, retail, wholesale, and manufacturing businesses sell inventory at a price higher than the cost. But before we can determine the sales price, we must know the cost of inventory. If we do not know the cost of inventory, there is a risk that we may set the selling price below the actual cost, and ultimately we will bear the loss by selling the items. So because of this reason, it is important that we understand what can be included as cost of inventory. And there are three main components for cost of inventory. First, cost of purchase. And what are those costs? So let's have a look at slide 7. And we will come back for other types of costs that are mentioned on this slide. So cost of purchase include purchase price, import duties, non-refundable purchase taxes. Now this does not include GST on purchase of goods, because GST on purchase of goods are recoverable. We are also including transport costs. Specifically, we will include freight inwards, meaning freight costs sold FOB free on board shipping point, because freight costs sold FOB shipping point are paid by buyers or by the company, so they can recoup this cost. However, we cannot include freight costs if goods are sold FOB destinations, because the freight costs are actually paid by the seller or the supplier. Therefore, the buyer cannot claim for these costs. We may also include other direct costs for the purchase. And note that we should not include trade discounts. We get trade discounts when we buy in bulks or we have good relationship with the suppliers. We should not include cash discounts. And when do we get cash discounts? Usually we get cash discounts if we make a prompt or timely payment. And we cannot include other types of rebates. For example, promotional rebates. You will have promotional rebates, for example, when you display the supplier's items and helps to promote the supplier's products. So trade discounts, cash discounts, and rebates cannot be included as part of the cost of purchase. So let's go back to the previous slide. So in addition to cost of purchase, we need to also include the cost of conversion, meaning the cost incurred to produce the finished goods. An example would be labor and production overhead. And the cost of conversion is actually within the scope of management accounting, and you will learn more when you actually do a more advanced accounting unit. The third component can include other costs incurred to bring inventories to the present location and condition. For example, the specific design expenses in producing goods for individual customers can be included. Some products are unique because we know that products are tailor-made for customers, so the specific design expense can be included as cost of inventory. However, please remember that we do not include admin, storage, and selling costs as cost of inventory. This slide summarizes the cycle of inventory. So how does inventory flow? So we begin with the opening inventory. When we purchase inventory, we record in the inventory account, and the tool will give us the cost of goods available for sale. And when we sell inventory, it will reduce our inventory. And when we sell inventory, we will also recognize the cost of goods sold. And the difference between cost of goods available for sale and cost of goods sold will be our closing inventory. And we need to compare the closing balance with physical count or stock count to see if there is any inventory loss. So this slide contrasts the inventory cost flow for retailer versus manufacturer. In regards to retailer, we have opening balance at the debit side of inventory. When we purchase, we will debit inventory to increase its balance. When we sell, we reduce inventory with a credit entry, and this will flow to the debit side of cost of goods sold. In this topic, in this unit, we focus on retailer. The inventory cost flow for manufacturer is more complicated, and you will get a chance to learn more when you do management accounting unit. For the raw materials purchased and labor and overhead incurred, we will close them to an account which is called work in progress account, because we want to recoup the costs and expenses incurred during our production. And recall that work in progress is an asset account. It is a type of inventory account. When the goods are completed, we will close work in progress account with a credit entry, and we will transfer it to the debit side of finished goods or finished inventory account. When we sell the finished goods, we will credit finished goods account and debit cost of goods sold. There are two methods to account for inventory: the perpetual inventory method and the periodic count method. So let's contrast them. Under the perpetual method, we record both opening inventory and inventory purchase as an asset. So in this case, we do not use purchase account. So for the perpetual inventory method, please do not use the purchase account, because we record both opening inventory and inventory purchase during the period using the inventory account. So there is no purchase account here. On the other hand, if we use the periodic count method, we will record opening inventory as an asset. However, purchase of inventory during the period will be treated as an expense because we will use purchase account. And purchase account is an expense account. It is not an asset account. And please note that in today's topic, we assume that the cost of inventory is constant, meaning your opening inventory and purchase of inventory has the same unit cost. If the cost of inventory is $1, it will stay $1 at all times. However, in reality, the cost of inventory always fluctuates, and this will affect the calculation for the cost of goods sold and closing inventory. In the next topic, we will look at scenarios when inventory cost changes from time to time. But for this topic, let's keep it simple. We focus on scenario where inventory cost remains the same. Under the perpetual inventory method, we use inventory account to continuously record inflows and outflows of inventory. Therefore, we have continuous records of cost of goods sold and closing inventory. In other words, with this method, we can tell the amount of cost of goods sold and inventory immediately. Under the perpetual method, we will also compare the closing inventory balance with physical count or stock count. So we perform a stock count to identify if the balance figure on the book matches the physical balance. We do this as part of internal control to detect if there is any theft or recording error. Any discrepancy will be recorded as inventory gain or loss, and we subsequently adjust the closing balance of inventory. So the advantage of perpetual method is that it leads to better inventory management and strong internal control, and we are able to obtain more timely information about inventory. Now let's look at the periodic count method. Under the periodic count method, we do not have continuous records of cost of goods sold, because cost of goods sold is only derived at the end of the period. And we will talk about how we derive cost of goods sold under the periodic count method later. Under the periodic method, because we don't maintain running balance of inventory, we cannot tell what is the closing balance of inventory. Therefore, we have to use the physical count or stock count to determine the closing balance of inventory. In other words, when we do stock count or physical count, that figure will be equal to closing balance of inventory, and there is no stock gain or stock loss. So there is no inventory gain or inventory loss. And under the periodic count method, we record inventory purchase using purchase account, which is an expense account. Okay, so please remember the purchase account is an expense account. It is not an asset account. And correspondingly, when we return goods to suppliers, we will record them using purchase returns and allowances accounts. And purchase returns and allowances account is a contra purchase account or contra expense account, if you like. So, should a company use perpetual or periodic method? It is really up to the company. And note that the choice between perpetual and periodic method is only a record-keeping choice. It is not a reporting choice. What does it mean? It means companies do not need to disclose whether they use perpetual method or periodic method in the annual report. And of course, the choice depends on various factors. It depends on the nature of inventory, for example. If the inventory has more stable costs, periodic method seems fine. Otherwise, perpetual method is preferred. It also depends on the cost of inventory. If the inventory is luxury item like diamonds, companies will only use the perpetual method because it is important for companies to closely track the inventory when the inventory has high value. It also depends on the information systems in the company. The disadvantage of perpetual method is that it can be very costly. However, with technological improvement like scanner and barcode, the cost for perpetual method have actually reduced over time and become more affordable for businesses, especially for small businesses as well. Now, let's look at the pro forma entries for the perpetual method. When we purchase inventory from suppliers, we debit inventory at a price net of GST. So inventory does not include the GST amount. And we debit GST clearing. If we debit GST clearing, it means we have GST recoverable. So GST recoverable or GST receivable, because businesses can claim GST refund for purchase of goods and services. Then we credit bank or accounts payable with GST inclusive amount. When we return inventory to suppliers, we debit cash at bank or accounts payable with GST inclusive amount. Then we credit inventory, and note that when we credit inventory, this amount does not include GST. And then we credit GST clearing because we reduce GST recoverable or we reduce GST receivable. When we sell inventories, we debit bank or accounts receivable, and again, this amount includes GST. We credit sales revenue at selling price net of GST, so meaning when you credit sales revenue, never include the GST. And you credit GST clearing. When you credit GST clearing, it means you have GST payable, which is a liability. Because when we sell inventory, we collect GST from customers, which is payable to the ATO. And immediately, we also need to record cost of goods sold. To record cost of goods sold, we debit cost of goods sold and credit inventory. And note that for the second entry, there is no GST, and you record the amount at cost price. When customers return inventory to us, we will debit sales returns and allowances. Okay, so sales returns and allowances is actually a contra sales account. Okay, and we need to record this at selling price, but do not include GST for sales returns and allowances. And then we debit GST clearing because it reduces GST payable. And we credit bank and accounts receivable at selling price, and this amount always includes GST. And we also have to adjust our cost of goods sold. So because the inventory is returned to us, we debit inventory and we credit cost of goods sold. Okay, and these figures are cost price with no GST. Under the perpetual method, we will compare the closing balance of inventory with physical count or stock count. If the count is less than the ledger balance, we will have stock loss. To record stock loss, we debit inventory shortage expense, credit inventory. Conversely, if the count is greater than the ledger balance, we will have stock gain. So we will debit inventory, credit inventory gain income. And note that there is no GST effect for both of the entry here. Under the perpetual method, because we constantly update our closing inventory on cost of goods sold, the closing balance or the closing figure of cost of goods sold can be used directly in the closing entry. Because it is an expense account, it will be close to P&L summary. So the closing entries for both methods are quite different. Under the perpetual method, we will close various expenses and contra income accounts with a credit entry. So specifically, we credit cost of goods sold, we credit inventory shortage expense, if any, we will credit sales returns and allowances, and we will also credit other expenses. For example, your discount allowed, so your discount allowed or discount expense. You will also credit your freight inwards, that is your transportation costs, and so on. Then you debit P&L summary with the total. Then we close the income account with a debit entry. So we will debit sales revenue, we will debit inventory gain income if there is any, and we will also debit discount receive or discount revenue. And then we credit the total to P&L summary account. Finally, if we have profit, we will close the profit to retain profit accounts. So we will debit profit and loss summary and credit retained profits. So this is an example for the income statement under the perpetual method. So we start with sales revenue minus sales returns and allowances, and we will also add discount revenue. If you have discount revenue, it will be added below sales returns and allowances. This will give us net revenue. And then we will deduct cost of goods sold, and we will also deduct freight inwards if there is any. And this will give us gross profit. And then from gross profit, we will further deduct inventory shortage expense, meaning inventory loss or stock loss, and this will give us adjusted gross profit. And from adjusted gross profit, we will minus all sorts of operating expenses, which include discount expense or discount allowed, for example, and that will give us our net profit. Okay, let's go through this student task using the perpetual method, and you must account for GST in this student task. So let's assume that you have attempted this question. Let's first go through the journal entries. On 1st of June, purchase 8.8k GST inclusive of inventory on credit. So we would debit inventory 8k net of GST. So this is 10 over 11 of 8.8k. we always record inventory net of GST. And then we debit GST clearing. When we debit GST clearing, it means that we have GST recoverable. And this is 1 over 11 of 8.8K, so 800. And we credit accounts payable always with the full amount, 11 over 11, 8.8K. On 2nd June, we return $440 GST inclusive of inventory booked on credit. So what we would do here is we debit accounts payable 440, so this includes GST amount 11 over 11, and we credit inventory $400. This amount is net of GST, so 10 over 11, and we credit GST clearing, meaning we actually reduce our GST receivable. So this is to actually reduce GST receivable. Or recoverable, and this is 1 over 11 of 440. Then on 3rd of June, we sold inventory on credit for 19.8K GST inclusive. The cost is $6,000. So what we will do here is we debit accounts receivable, and again with receivable we also include the full amount, the GST inclusive amount, so 11 over 11, 19.8K, and we credit GST clearing. When we credit GST clearing, it means that we actually have GST payable because we collect tax from customers, and that tax is actually payable to the ATO. So this is 1 over 11 of 19.8K, it gives us 1.8K, and then we credit our sales revenue 18K, and sales revenue is always at GST exclusive amount, so 10 over 11. And we also need to record cost of goods sold because under the perpetual method, we continuously track our cost of goods sold. So we have to debit cost of goods sold, credit inventory at the cost, which is $6,000 here. Okay, and for this second entry, there is no GST because we always record our inventory net of GST. Therefore, when we record the cost of goods sold, there is no GST effect. Then, on 4th of June, customer returned $660 of goods, and this customer actually purchased on credit, and the cost price is $200. So first of all, we have to debit sales returns and allowances, which is a contra sale account at selling price net of GST. So this is 10 over 11, 600. And we debit GST clearing $60. When we debit GST clearing, in this case, it means we try to reduce GST payable. And we will credit accounts receivable at selling price, inclusive of GST, 660. So this is 11 over 11. Then we also have to adjust our cost of goods sold because we receive the inventory from clients. We debit inventory and we credit cost of goods sold $200, and again there is no GST effect here. Then on 5th of June, we receive payment from customers for amount owing less 5% for settlement discount. So what we will do here is we debit cash at bank 18183, and how do we get this figure? 19.8K. This is the original accounts receivable minus 660 sales returns and times 95%. We debit discount allowed or discount expense 870, and how do we calculate that? Again, you start with accounts receivable 19.8K minus the sales return 660 multiplied by 5% because we give 5% discount, and we need to make sure that this amount is net of GST, so we have to exclude GST. Therefore, we multiply by 10 over 11. And we debit GST clearing We debit GST clearing because when we actually give discount, it will reduce GST payable. And how do you get $87? So 19.8K accounts receivable minus sales return 660 multiplied by 5% of discount, then multiply 1 over 11. And you credit accounts receivable with the full amount 19140, which is 19.8K accounts receivable minus 660 sales returns. Then, on 6th of June, you paid freight inwards of $132 GST inclusive. Transportation has GST because it is a form of service. So we debit freight inwards 120 net of GST. We debit GST clearing $12 as businesses have GST recoverable from purchase of service. So this is 10 over 11 and this is 1 over 11, and then you credit cash at bank with GST inclusive amount 132. On 7th of June, you paid creditor $7,500 in full settlement of account. In this case, we actually owe creditor or supplier 8360 because previously we purchased at 8.8K, but we actually returned $440 of goods. So to settle the accounts payable, we would debit accounts payable with 8360, but we only paid $7,500. It means there are discount revenue. So we credit cash at bank $7,500. This is how much we paid, and we credit discount received or discount revenue with the differential amount. So 8360 minus 7,500, but we need to make sure that we take out the GST. So we multiply 10 over 11, that gives us 782. So 782 is our discount revenue or discount received, and we have GST clearing, we credit GST clearing with $78. So which is 8360 minus 7,500 times 1 over 11. Because when we receive discount revenue, it will actually reduce our GST recoverable. Then on 8th of June, we do a stock count, a physical count. It showed that we have $1,600 of inventory on hand. Do we have stock gain or do we have stock loss in this case? First, we should determine the closing balance of inventory. And we know that the closing balance of inventory in this case is actually 1.8K. And how do we get that? So 8K minus 4K minus 6K plus 200. If you trace all the transactions above, this will give us 1.8K. So the book shows 1.8K, stock count shows only 1.6K. In other words, we actually have inventory loss. So perhaps employees have stolen our inventory. So we debit inventory shortage expense $200 and we credit inventory $200. And then we are also required to perform the closing entries. So first of all, we close various expense and contra income accounts with a credit entry. Specifically, we credit sales returns and allowances $600. We credit cost of goods sold $5,800. So this is the purchase, $6,000 purchase minus $200 of purchase returns. We credit discount allowed $870. We credit freight inwards $120. We credit inventory shortage expense or inventory loss $200, and then debit P&L summary 7590. Then we close the income accounts with a debit entry. To do this, we debit sales revenue 18K, we debit discount revenue or discount received 782, and then we credit the total 18782 to P&L summary. In this case, because our income is greater than expense, we have a net profit and we have to close our net profit to retain profit. To do this, we debit profit and loss summary 11192 and we credit retained profits 11192. And this is the income statement under the Perpetual method. So we start with sales revenue 18K minus sales returns and allowances 600, and we add discount revenue 782. That will give us net revenue 18182. We deduct cost of goods sold 5800, deduct freight inwards 120. That will give us our gross profit. Our gross profit here is 12262. We then deduct inventory shortage expense or inventory loss $200 to get adjusted gross profit 12062. We then deduct operating expenses. In this case, we have discount allowed or discount expense 870, and our net profit is 11192. Alright, in the next few slides, we will practice the periodic count method. Recall that we do not track inventory when we use the periodic count method because the cost of goods sold is actually derived. And how do we derive the cost of goods sold under the periodic method? It is shown in this diagram. First, we start with opening inventory, which we obtain from the previous period stock count. We then add the purchase made in the current period to derive cost of goods available for sale. Then we will perform a stock count, a physical count to obtain the closing inventory. The difference between cost of goods available for sale and the closing inventory will be deemed as cost of goods sold. So let's look at some pro forma entries. When we purchase under the periodic method, we debit purchase, which is an expense account, and this is net of GST. So please do not include GST in the purchase account. And we debit GST clearing. When we debit GST clearing, it means that we have GST recoverable or receivable on the purchase of goods, and we credit cash out accounts payable always with the GST inclusive amount. When we return inventory to suppliers, we debit cash at bank or accounts payable with GST inclusive amount, and we credit purchase returns and allowances, and this is a contra purchase account or contra expense account, and for this amount we do not include GST as well. And then we credit GST clearing. When we credit GST clearing, in this case, it is because it reduces our GST recoverable when we return inventory to suppliers. So note that we use purchase and purchase return accounts instead of inventory account under the periodic method. When we sell inventory, we debit bank or accounts receivable with selling price, and this amount always include the GST. We credit sales revenue at selling price, but this does not include GST. And we credit GST clearing. When we credit GST clearing, it means that we have GST payable, because when we sell inventory, we collect tax from customers, which is actually payable to the ATO. When customers return us inventory, we debit sales returns and allowances. This is a contra sales account, and for this account, please do not include the GST. And we debit GST clearing to reduce the GST payable, because when we return when customers return goods to us, this will reduce the GST payment, and this will therefore reduce GST payable. And we credit bank or accounts receivable inclusive of GST. So these entries are basically the same under the perpetual method. The same as the perpetual method. The only difference is that we do not need to record cost of goods sold because we do not keep continuous records of cost of goods sold under the periodic method. Because we do not maintain a running balance of inventory, the amount of cost of goods sold can only be determined indirectly. It actually involves 3 steps. To determine cost of goods sold under the periodic method, first we need to close opening inventory and purchases to P&L summary. So in other words, here we will debit P&L summary and we will credit inventory but note that we credit inventory using the opening figure. And we will also credit purchase account. And remember, purchase account is an expense account. Then, we will close purchase returns and allowances to P&L summary. So in other words, we would debit purchase returns and allowances because it is a contra expense account, and we will credit P&L summary. Third, we create closing inventory as per stock take. So meaning using the stock take figure, we will debit inventory account. And we will credit P&L summary. So that's how you actually determine the cost of goods sold under the periodic method. So this slide basically summarizes the pro forma closing entries when you use the periodic method. Under the periodic method, we first close opening inventory, expense, and contra income accounts. So you find that we credit inventory, opening inventory at the start, so meaning opening inventory figure, and we credit purchase made during the period. We will credit sales and returns allowances, and we will also credit other expenses such as discount allowed and freight. Okay, for example, discount expense and freight will also be credited because they are expenses. And then we debit the total figure in the P&L summary account. Then we will set up the closing inventory, close the income and contra expense accounts. So here we debit sales revenue, we debit purchase returns because purchase returns and allowances is a contra purchase account, is a contra expense account, and we will also debit other revenue such as discount revenue. For example, if you have any discount revenue, you would debit it here. And we debit inventory because, as mentioned, we do not actually maintain a continuous records of inventory. So when we do the stock count, that figure will be our closing inventory. So to set up the closing inventory, we will debit inventory using the closing figure, the stock take figure, and we will credit to P&L summary. So you take the difference between the first part and the second part. If your income is greater than expense, you will have net profit. If you have net profit, you have to close it to retained profit accounts. So you debit P&L summary and credit retained profits if you have net profit. So the income statement for periodic method actually has the following format. So we start with sales revenue minus sales returns and allowances to get, and then we will also add discount revenue here if any. So this will give us the net revenue. Then we minus cost of goods sold. And please remember that the cost of goods sold is actually derived. So we start with opening inventory plus purchase minus purchase returns. And if you have any freight inwards, you should also include it here. Because freight inwards can be included as cost of inventory. And then we will minus the closing inventory, and this will give us the cost of goods sold. So this is cost of goods sold. Okay, minus closing inventory, this will give us cost of goods sold. And if you use the net revenue minus cost of goods sold, this will give us the gross profit. And we will further deduct all the operating expenses. So we will minus operating expenses, such as discount allowed or discount expense, to get net profit. Alright, using the same question from the previous student task, now we are required to record the transactions, including doing the closing entries using the periodic method. So let's assume that you have attempted this question. Okay, so 1st of June, we purchased 8.8k GST inclusive of inventory on credit. We will debit purchase account, net of GST. So 10 over 11, and we debit GST clearing because we have GST recoverable when we purchase goods and services. So this is GST recoverable 1 over 11, and we will credit accounts payable with the GST inclusive amount 11 over 11. Then on 2nd June, we return $440 GST inclusive of inventory book on credit. So we debit accounts payable, GST inclusive amount 11.11 over 11. 11 over 11 is 440. And we credit purchase returns and allowances 400. This is net of GST. And we will credit GST clearing because we actually reduce GST receivable or GST recoverable 1 over 11, $40. And on 3rd of June, we sold inventory on credit for 19.8k GST inclusive. The cost is $6,000. So we debit accounts receivable 19.8k. So this is GST inclusive amount. And we credit GST clearing, because when we sell something, we will collect tax from clients, from customers, and those GST are payable to the ATO. So we actually recognize GST payable 1.8k. So this is 1 over 11. And then we credit sales revenue 18k, which is net of GST 10 over 11. And we do not need to record cost of goods sold because under the periodic method, we only derive cost of goods sold at the end of the period when we do the closing entry. On 4th of June, customer returned $660 on credit and the cost price is $200. So we debit sales and returns allowances $600, which is a contrast sale account, at selling price net of GST $600. So this is 10 over 11. And then we debit GST clearing because this will reduce GST payable, $60. So 1 over 11. And we credit accounts receivable with the full amount 11 over 11, $660. On 5th of June, we receive a payment from customer for amount owing less 5% for settlement discount. So we debit cash at bank 18183 because 19.8k is the accounts receivable minus $660 of sales returns multiplied by 95%, so 18183. And we also have discount allowed in this case 870, so 19800 minus 660 times 5% of discount, but we need to take out the GST, and therefore we multiply by 10 over 11. And we debit GST clearing $87, that is 19.8k minus 660 multiplied by 5% multiplied by 1 over 11. When we debit GST clearing in this case, it means we actually try to reduce GST payable. And then we credit accounts receivable with 19140, which is 19.8k minus $660 of sales returns. Then on 6th of June, we paid freight inwards of $132, GST inclusive. And remember, transportation has GST because it is a form of service. So we debit freight inwards $120 net of GST, debit GST clearing $12 because businesses have GST recoverable from purchase of service. So this is 10 over 11, this is 1 over 11, and credit cash at bank, GST inclusive amount 132. And on 7th of June, we paid creditors $7,500 in full settlement of account. In this case, we only owe the creditor or supplier 8360 because we purchased on credit 8.8k, and then there is a purchase return of 440. If $7,500 is a settlement account, is a settlement amount, it means that we actually have discount revenue. So we credit cash at bank $7,500. This is the amount that we pay. And then we credit discount revenue or discount received 782. So that is 8360 minus $7,500, and we need to take out the GST, so we multiply by 10 over 11, and we credit GST clearing $78. So which is 8360 minus $7,500 and multiply by 1 over 11 because we try to reduce GST recoverable when we receive discount. And you're also given another information. A physical count show $1,600 of inventory on hand. The stock count means the closing balance for inventory, and we would do the closing, and we'll do it as part of the closing entry later. So let's do the closing entry. First of all, we will close the opening inventory, expense and contra income accounts. So we credit sales returns and allowances $600. We credit purchase during the period 8k. We credit other expenses including discount allowed 870 and freight inwards 120. And we credit opening inventory. And in this case, the opening inventory is not given, so we assume it to be 0. We then debit P&L summary the total 9590. Then we have to set up closing inventory, close the income and control expense accounts. We debit sales revenue 18K. We debit other revenue like discount revenue 782. Debit purchase returns and allowance 400. We debit closing inventory, and this is given in the question. The stock count shows that the closing inventory is 1,600, so we can use it directly. And we credit P&L summary the total 2782. And in this case, because our total income is greater than total expense, so we have profit. So we debit P&L summary, credit retained profits 11192. Alright, let's prepare the income statement. We start with sales revenue 18K, minus sales returns and allowances 600. We add discount receive or discount revenue 782. Our net revenue is 18182. We then deduct cost of goods sold. And note that cost of goods sold is derived in this method. So we have opening balance, which is assumed to be 0 in this case, plus purchase 8K, deduct purchase returns 400, and we have freight inwards, so we have to include freight inwards because freight inwards will be considered as part of the cost of inventory, 120. Then we less closing inventory as per stock take. This is given 1,600. So our cost of goods sold is actually 6120. So 6120 is our cost of goods sold. Net revenue minus cost of goods sold 6120. This gives us our gross profit 12062. We further deduct operating expenses including discount allowed 870 to obtain net profit 11192. So if we compare the income statement on this slide under the periodic method with the income statement on slide 26 under the perpetual method, what can you observe? You find that the net profit is the same, but the gross profit is different under the two methods. But no matter which methods that you use, whether you use the perpetual method or the periodic method, it must always end up with the same net profit. The gross profit can be different, but the net profit must be the same. Okay, so please go through revision question of case study 7. We will discuss at the start of the next topic.